right. Should be good to go. There we go. Thank you, everybody, for being here. I am super stoked. Got a special cup of coffee going just for this. All right. Okay, let's get started again. We got a lot to cover. I can see so me and the team can see your questions. Give me some time to get through the presentation. I'm happy to answer some Q&A. All right, so let's get to it. Trading ETFs and stock options in 5 hours a week. This has been something for me that's really been a decade in the making. So excited to present this to you guys. We're going to take a dive into this time efficient and much more, well, for me, profitable way of a less is more approach. Okay, so let's get to it. What are you going to learn tonight? All right, what you need to know to trade options on ETFs, options on stocks in 5 hours a week, or approximately 1 hour a day. Sometimes less, maybe sometimes a little bit more, but usually a little bit less. Being a retail trader should not be a full-time job. I do not consider myself, in terms of hours, gang, a full-time trader. You can get your time back each day. You can be more consistent in your trading if you know what steps need to be taken. Now, again, what I'm keeping in mind and what I'd love for you guys to keep in mind is the less is more when it comes to your trading. Staring at the charts and your computers all day is not what your P&L needs to see for steady growth year after year. Later on, we're going to talk about a results economy versus a time economy in trading and why you're probably stuck in the wrong mindset, which is making trading much more difficult than it needs to be. There is a proven strategy, gang, to make this happen, and we're going to lay that idea out, lay that plan out here today. All right, so how do I know the strategy? Well, I live it, right? This is my life. This has been my life for 3.5 decades. My end of day, that's what EOD is. So my end of day trades, all right, take no more than 5 hours a week to find, or like I said, about 1 hour a day to trade and execute, all right? My time is my own. Now, this isn't just about, oh, free your time. This is about using time more efficiently. Again, less is more. I have plenty of time in my life to pursue interests that I have. Sometimes that's becoming a better trader. Sometimes that's reading a lot of books. Sometimes that's finding ways to, again, improve my portfolio or my investing. I've been consistently profitable year after year for the past 30 years. That means year in and year out, gang, I have not had a losing year. I've had losing days. I've had losing months. I'm going to share with you 2020 in a little bit, but I haven't had a losing year. All right. So despite 2020 being the year that it has been, I've been profitable 11 out of 12 months. I'm going to share all that with you guys. 2010, this takes me way back, but it's pretty exciting how things just kind of come full circle. 2010, I wrote a book about trading 5 hours a week. And I'm pretty sure that was on the heels of reading Tim Ferriss's 4-Hour Work Week, because that really resonated with me. My 2010 book, 4X on 5, applies to all trading, including the options, ETF, and option stocks approach we're going to talk about here today. All right. So really excited about this. Think about less is more, gang. All right. So before we get into this, everything is recorded. I always encourage everyone to actively take notes, write down questions that you might have. We'll spend some time for Q&A after the presentation is done, but this is recorded and we do send it out pretty darn quick. So you guys can review it, as soon as probably tomorrow. All right. So again, everything is recorded. All right, let's get to it. So this is that aforementioned book that I talked about. There is an approach you can use to increase your profits and reduce your time trading. And the reducing your time trading absolutely relates back to increasing your profits. I absolutely believe these two things are related. All right. So at first it may seem a little counterintuitive, no doubt. I know at first it might seem, wait a minute, Ron, this seems a little too good to be true. But I'm telling you right now, when I start laying out how we do it, you'll realize it works. Okay. So again, think outside of the box. Think about what you have been doing and is it yielding the results you want? Because if it's not, it may be time to shake things up a little bit. So let's talk about what I've been doing through 2020. So I don't believe in looking at P&L per trade. All right. I look at looking at P&L through the month. I look at through the entire year. So this is 2020. Each month, just over 100 different positions. You can see my win rate here, 75%. That's not as big a deal as it sounds. Okay, but it's a good win rate. If I take about 7.5 out of 10 trades are winners. This account began with, I believe it was 24 or 27K. I think it was 27K. All right. No pattern day trading issues. I know a lot of folks ask, Ron, what about pattern day trading? No problem with that. That's not the kind of trading we're talking about. No over trading. This is selective trading at its best. All right. So one cool thing about 2020, I know it's kind of funny to say that, but you survived it. All right. And you saw every type of market behavior from a 2008 style crash. Even some folks were citing a 1929 style crash that was earlier Q1. Then a 1999 style bubble, right, which some argue might even still be in play. And then some chop thrown in October, November. Pretty much anything the market can throw at you, it's thrown at you in 2020. All right. What do? You adapt to the psychology, you adapt to the trends. And that's what this is all about. So up, down, sideways, chop. We need to identify the market that we're in. And this is how you can get those kind of results. All right. So we'll come back to some of this in a little bit, but I just want to show you this is what's possible. All right. And you don't need a huge account to do it. So let's talk about some trade examples. All right. And I'll be happy to answer some questions at the end. All right. So this is Costco. These are all relatively recent trades. And this is Costco. Now, what do we do with Costco? This is an $1,160 profit per contract. Now, we're going to talk about per contract. We're going to talk about cost of contracts, etc. What we're doing, though, is we're specializing in the best markets. That comes first. And the best kind of market is double green, right? It's the environment that is most likely to produce winning trades, period, gang. All right. In other words, there's an environment, whether you know it or not, there's an environment when you saw your P&L grow, the market was behaving in a very specific way. This is the environment that I like to go shopping, as I like to say. I have to scoop up options. I look for specific times and I look for things to go on sale. All right. I call them blue light specials. Maybe I'm dating myself a little bit, but that's literally what I imagine in my mind, a blue light special, something's going on sale. That's the approach I created to get into the market. In this case, long calls. All right. This is a reminder to look at options when they go on sale. All right. So at the very bottom of this screen, you can see what I bought, what I paid, and the profit. Now, this is across multiple contracts in this case, right? This is the entire trade. This is per contract, because some folks might buy 4, some folks might buy 8, some folks might buy 1. Well, we'll talk about budgets a little bit later on. But at the end of the day, what we want to focus on, again, is the right environment and scooping up the options that we want on sale, all right? Preventing us from overpaying, which is the main issue with options traders who want to play directionally. They chronically overpay, all right? You can be a winner trading options directionally, whether you're selling premium, buying calls, all right? But keep those points in mind. All right, let's just jump on over to the next chart. This is FedEx. All right, so we just talked about a $1,615 profit in Costco per contract. Here's FedEx, $1,600. Let's see, this is, $1,615 on FedEx. Again, you can see here at the very bottom what we did and the ultimate profit for the entire trade. All right, what did we do again? In this case, I want you to take a look at a few things on this chart. I'll show you a little bit later on, but this particular setup is my bread and butter, right? Waiting for some retracements, blue grab candles, no chasing, the trade coming into my zone, almost like a strike zone, right? We're waiting for our pitch. Buying the dip works. It works well. But if you do this kind of strategy in the wrong type of market, it fails miserably. So remember this. You might want to jot this down even. Get the trend right, and you are more likely to get the trade right. Get the trend right first. The trade really starts to take care of itself. All right, moving on to XLY. This has been a gift that keeps on giving, and I suspect as we go through 2021, gang, you're going to want to keep an eye on the XLY Consumer Discretionary ETF. So here, this is a $425 per contract. But what I want to point out on this one is this large green candle here, for a lot of traders, they got slam dunked. They got full on whack-a-mole because they weren't patient. They were chasing a market. They weren't waiting for their pitch. Look, I'm not glued to my charts. I am waiting for my price, just like a great all-star major league batter. I'm waiting for my pitch, waiting for my price. And frankly, the platform does this for me. I'm going to show you guys throughout today how you use your platform as a second set of eyes, as a trading partner in the room. It's like a good alarm clock, all right? So this is being effective in placing trades and not being glued to your chart. In fact, traders who are glued to their charts probably acted on this because there's a temptation there, right? We want to avoid those temptations. So again, we're going to use our platform to help us out, to alert us to specifically the zones that we want. For me, that zone was down in here, all right? So in this case, we trusted our watch list, we trusted our trend, and you'll notice the tools that I use are color-coded, right? Sort of like paint by numbers. I know exactly what I want to do and the environment that we're looking to do it within. So this was definitely a buy the dip opportunity and one that we were able to wait for our pitch. All right. So with that in mind, those three examples in mind, that particular strategy that I love to deploy, it's been a big part of 2020. It's going to be a huge part of 2021. This is something a little bit different. All right. And hopefully this gets the point across of it's not about home runs, gang. It's about consistently getting on base. So what you have here is all my trades last year, all kind of dot plotted. They're overlapped, as you can see here. But here's what I want you guys to think about. All right. No single trade should ever end your career or your account for that matter. This line right here is 0. Now, I'm not saying we don't lose. There are course losses here, but we keep them tight. We keep them small. We keep them from blowing up our account. Gang, I've never blown up an account, right? We're talking about batting runs in. We're talking about consistency. We're making sure losses don't get away from us. By the way, I'm not talking about home runs and grand slams either. I'm talking about keeping a very consistent, profitable approach. Don't let the losses get too big. Keep lots of consistent winners. And every now and then you really connect well with the ball, if you will. And yeah, you're going to get a home run or two. You're going to get a grand slam as well. All right. But when I have a loss, notice again, they're small and they are far outnumbered by our wins. Okay. So this is the kind of thing that I study when I look at my trades. Am I letting certain losses, am I letting certain trades get away from me, or am I being very consistent? All right. So the keys to successfully trading 5 hours a week. Now remember, the 5 hours a week is not about just keeping it quick. It's about really keeping it high quality. All right. I know a lot of people think, oh, this is, I'll just get my analysis done quickly. No, you can. But this is really about sticking with high quality. When you limit the amount of time you can spend on the market, interestingly enough, the byproduct of that is high quality trades. What is a high quality trade? First of all, it is finding the relative outperformers. This is so important, gang. Very important. It's really integral to what we're going to do here and talk about together. If something is working, stick with it. Think trends, gang. A lot of times traders, they press trades they shouldn't, and they abandon trades they shouldn't, right? We stick with the trends. And that brings us to the right watch list wins the day. I'm going to refer to something called double greens a lot. And that's the environment that we want to stick with. It's actually a really good indication of a market indicating that higher is the path of least resistance. And by the way, gang, we do want to focus on uptrends. Downtrends are fine. They're a little different to beast, but we want to focus on uptrends. And again, after studying my own accounts for decades, teaching traders, observing traders for many years, I'll tell you that the one thing I find that most traders do, they trade the best in an uptrending environment. So that's really part and parcel with finding the right watch list. Now, this is where this gets kind of interesting, and this is where a lot of traders haven't thought about the importance of ETFs, gang. We bring up ETFs not because we're just trading ETFs, but because the attention and the influence of ETFs have made finding stocks to trade the easiest they've ever been. And then finally, we get down to timing. Time and timing. The patience to enter the trade and the patience to let the trade work for you. Okay? In other words, getting the timing for the entry right and getting the expiration for your options right. All right? These are the keys, gang. All right. Next up, let's talk about some more charting examples. This is Starbucks. Starbucks has been great. In that aforementioned XLY ETF, this one was a $965 profit per contract. Again, this goes back to if something is working, stick with it. I've been in and out of Starbucks multiple times, right? Just sort of leapfrogging off these opportunities to take pullbacks, sticking with something if it works. It saves you time. It saves you time. Another major point in this trade is to use the trend and inexpensive options. You'll see that what I like to focus on personally are options that are usually below 10 bucks. All right. So that's $1,000. So yes, for those of you that are wondering, Rog, how much do I need in my account to be able to trade this way? By design, gang, very little. All right. Because I don't want you guys getting into 20, 50, 70, $100 options. It usually presents way too much cost and way too much risk. Okay. Now, what's really cool about this Starbucks trade, $3.30 per option, which in terms of dollars is 330 bucks. Low risk, low cost. And then you guys can see here, it doesn't mean low profit, gang. It's just us finding those blue light specials. All right. Moving on then to, again, the point that I want you thinking about when it comes to Starbucks. Let's recap a few things here. If something is working, stick with it. I talked about getting the environment right, following the trend, the path of least resistance. This is what saves you time and money because you're not wasting your time chasing the shiny and new, chasing whatever's being talked about on financial media or FinTwit or wherever you might be bombarded with things. Okay. We stick with what works. And we stick with what works because we understand the underlying environment that we are most profitable within. Double green, right? So this is about the secret, right, to my trading success. Stick with the directional bias in the market. Be a one-way trader. Now, this also means if there isn't directional bias, we are out of there. So knowing when to stick with it, stay in, and knowing when to get out is all about that directional bias. Get that right. The trades almost take care of themselves because, again, it's more important what you trade, not how you trade it. And if what you're trading is in that double green, that uptrending directional bias, you can be a one-way trader and you can milk those trades for far more. Okay. All right. So let's talk about another example here. And this is UNH. All right. United Health. So in this scenario, this is a $570 per contract. And again, you can see the trades at the bottom of the screen here, gang. So patience and getting the expiration date right. This is something I commonly see traders do. And it saddens me because a lot of times traders are right about the direction of their trades, but they didn't give themselves enough time to let the trade work. So getting the expiration date right, not being in a time crunch, or as I like to say, you don't want to duke it out with the theta decay, with the time decay monster. The time decay monster will win, especially if you're playing directionally. So getting the time right is really important. No one wants to be right, but run out of time. Okay, so let's talk about some of the structure here. These are called blue grab candles. And these candles tell me that we pull back and we went neutral. Okay. So sometimes trades don't move in our direction right away. This is what I mean about patience and timing. If I don't give myself enough time to let a trade work, it can't. I knew to be patient because despite the pullback, this is the kind of stock that is more likely to resume a trend. All right. So think of it this way. Your indicators should be like a great instrumentation panel, keeping you heading in the right direction while alerting you to things that are important. What's important? That a market that was going up is pulling back, that you might have a blue light special with the blue grab candles. That's what I mean about having your indicators act as a really good instrumentation panel. So what do we get out of UNH? What do we know? What do we learn from a trade like that? Time and patience. Again, I see a lot of traders get out of a trade. It may not be hurting them. It may not be helping them. It's just sort of going sideways. But if you have some context for the sideways movement, you can wait through it as long as you're giving yourself time by not having expiration. It's right on top of, right? You need some time to expiration. I focus on not having to run out of time for my options to work. Okay, so what does that mean? 45 days, gang. All right. I typically do not like. Now remember, we're trading daily time frames. We're trading end of day. We're spending about 60 minutes or less per day. We can do that with longer term time frames. Give yourself that time. DTE, days to expiration, 45 days. It's the sweet spot I have found after thousands of options trades. That 45 days gives me time to let the setup work without time decay, eroding the value of my options. Okay. All right. So keep that in mind. Giving yourself time, 45 days to. Now, can you go more than that? Absolutely. You can go more, but just don't go less. All right. Moving on to another example. Oh, Schwab. Golly, Schwab has been amazing. At the very bottom, you can see what we paid for these options. Gang, I want to just again reiterate, you don't need to spend a lot of money. You don't need to buy expensive options. It just breaks my heart when traders with smaller accounts or lower risk tolerance feel that they need to trade $19, $20, $30, $70 options. This is a $2 option, gang. $2, $220 per, okay? $830 of profit per contract. So ask yourself, well, can I trade more than one $220 option? This is where, whether you're trading a small account or whether you're trading a large account, this is what I believe in. It's scalable. Okay. You really want this to be scalable. So as you get more profitable and confident as a trader, you can trade larger without having to go trade more expensive options, right? I love inexpensive options. They give me a lot of flexibility. All right. So that's Schwab. And by the way, a couple things about Schwab. No one was touching the financial sector at the time. This sector, this is, by the way, a stock within the XLF. Let's tie this back to ETFs for a moment. XLF was a dumpster fire. You guys might remember that. But interestingly enough, there was some interesting sign of life, double green in Schwab. So I thought, well, I may not want to play XLF in a whole, but playing an individual name like Schwab, relative outperformance, one of our keys, gave us a fantastic trade. All right. So this was a 2 to 3. I think I spent $2 to $3 per option on the way. Again, smaller, big account, no problem. And XLF may not have been a great sector. Most of the stocks within XLF weren't great, but Schwab was double green. All right. So this is where I use the ETFs or the indices to scan the market, because what do I know about Schwab? It's heavily weighted within the XLF. I'm guaranteed a certain amount of attention, right? What moves stocks? Attention, right? Whether that's news or whatever that variation of news is, we want to make sure we're where the attention is at. Okay. So 2 major keys to my trading approach were at play in Schwab. we use that pre-curated watch list of the XLF to find the symbol that would have the highest probability, right? The highest probability for follow through. The other thing that we did, right, we played an inexpensive option. Gosh, do I love inexpensive options that allowed us to control risk. If you've got a $10,000 account or a $110,000 account, all you're really doing is scaling how many contracts of SCHW you were trading. That's what I mean about scalability. All right. By the way, the risk on this trade, let's talk about risk for a moment. The risk on this trade was never more than $75 per option or 75 cents, however that computes easiest for you. So the return on that trade was 166%. Return on investment. The return on risk was a monster 966. All right. This is what you can do with inexpensive options, gang. All right. Moving on then to another example. Right, keep some of those ideas in mind, gang. This is Coke. We've been in and out of Coke quite a bit. This is a stock that trades within the XLP. This is the cyclical. What I like about certain stocks, these consumer staples, right, is, well, they're inexpensive. This is not a whopping profit, right? However, again, very inexpensive. I didn't trade a lot of these, but very inexpensive. And it's about time and timing. All right. So what do we wait for? We waited for our pitch. That was in the strike zone, if you will, right? We actually had to sit and wait for 3 days. But we're not getting impatient. Why? Because we don't have time breathing down our throats, or the time decay monster breathing down our throats. So not only can we sit through waiting for this market to basically gain traction and move higher, we can also let it continue to move higher in our favor. Double green, path of least resistance is up. Well, this is where having time on our side helps, because as the trade moves in our favor, even if it gets lethargic like this, I'm not losing sleep over it because I've got plenty of time working for me. Okay. So timing was to let it settle down and dip into our zone. That's the timing. And again, time to expiration did not rush me out of this market. All right. So think about time and timing, or time and patience. All right. Be patient. Let the price come to you in its own time. This is probably the single most difficult thing for traders to do. It really is. But notice when you do that, you can have affordable options, lower risk, and you've got the right zone where you can control risk from. All right. So we do not chase trades. A lot of traders do. And what happens when you chase trades? When the market pulls back, you can't sit through it, right? You can't sit through it. When you overpay, when you chase, you're not able to sit through those inevitable pullbacks. When you use the pullbacks, that's where you get those blue light specials, right? So what happens when you chase trades? You overpay. Overpaying for options puts a trader and the trade at a disadvantage. Okay, absolutely puts the trader and the trade. And overpaying is one of those things where when traders blow up accounts, or when they're chronically seeing their P&L move in the wrong direction, one of the things that you'll always notice is that they're overpaying. Okay, so then I ask myself a very, very simple, if not somewhat abrupt question. Do I hate my money? I do not. In fact, nobody cares for your money more than you do. If I'm not willing to put my money in harm's way, when would I do that? In a really good, high probability, low risk trade. Okay. Before you put your capital to work, ask, gosh, am I angry at you? Do you hate your money? Okay. Another chart example. Deer, cat, Honeywell. Keep an eye on those names, gang. You can jot those down. Those are going to be interesting ones going forward into this year. Deer, Honeywell, Caterpillar. This is a $610 per contract profit. Again, you can see all that at the bottom here. All right. So in this case, you're starting to see a pattern emerge, are you not? There's a couple of different setups that I like to use. I'm showing you guys probably one of the best ones that I use. All right. Finding the right environment first, right? Getting the environment right first. and then time and timing and patience. Okay. So this was a relative outperformer. I think it's going to continue to be one, by the way, and just, again, waiting for the trade to come back to you. And I know that it's going to feel crazy when the market's doing this and you're feeling like you missed it. And then it does this and you thought, yep, my patience was rewarded. All right. So what are we looking at here? Again, time and patience. All right. Moving on to another example. Oh, materials, XLB. Now you'll notice a couple things, gang. I'm toggling between individual stocks that are heavily weighted within the ETFs. I'm not scanning thousands of names. I'm scanning dozens of names, right? The world of stocks that I'm managing is very, very succinct. It's connected. It's manageable, right? I'm not overburdened by thousands and thousands of names that I'm not familiar with, and I'm not even assured that have attention on them. We use ETFs to not only trade a group of stocks, but we can also use the ETFs to find the best opportunity within different sectors. So in this case, I decided to go with the broader XLB. Again, another inexpensive option. And what happens when I'm using this connected approach, gang? This is how you can be trading and finding opportunities in less than 1 hour a day. And the idea is that when you're using these particular ETFs and the individual stocks within them, again, it doesn't take a lot of time and you're guaranteed this connectivity. All right. So this one's $140 per contract. Yeah, I bought a couple of them. And there's your profit there for this particular trade. And we're going to continue to look for pullbacks in XLB. This has been a really good sector. And there's a number of very interesting stocks within it. And that's where things get really interesting for us. So there's a couple questions that have popped up. I am happy to tackle those. So yeah, let's tackle a few questions here. And I think one of the earlier questions, was about April and May. Oh, where did May go? Well, gang, I did not trade in May. So I didn't close any trades in May. So for those of you that are wondering, and good eye, yeah, what happened to May in here? I entered some trades going into May, but this shows my closed P&L per month. This is not an unrealized P&L. These are closed P&Ls. So a lot of times they were rolling over to the next. So I built trades in May, but I did not exit them. Hence, you'll see how we exited in June. So I did not have any closed trades in May. I built trades in May, but closed none. And that's why that's there. Sure. And by the way, yeah, do I lose? Gang, here's April. Yeah, April was tough. April was tough because March was a really nice downtrend. And I was still looking for downtrending follow through because we had a lot of chop. And if you recall, we had a V bottom in April. So yeah, I lose. Yeah, a couple of folks are asking, how often do you lose? Less often, clearly less often than I win. But yeah, these are, and that's something else I want to drive home, gang. You've got to keep those losers in check. Notice how none of them are plotting way down here. Again, I've never blown up an account because I use the arithmetic of risk of ruin, right? You don't want to ever drive your account below 50% without pausing to find out what the heck is happening. All right. So I'd like to show you guys this kind of transparency because I hope you can see by being patient, this is not a super frequent way of trading. We don't get paid to put on trades. We get paid to close winners, gang. Frequency, activity, more time, more trades. That's not how we get profitable. And by the way, I talked about a results economy versus a time-based economy. If we're shifting from being employees where we're given credit for the hours that we put in, you think the market cares one bit about the time that we put into the market? That whole 9 to 5 thing? Nope. It only cares about the results. We live in a results-based economy, gang. And when you actually spend less time putting in trades and more time looking for the best type of trades and having the best fine-tuned watch list, you're really embracing that results economy versus being locked up in that time economy. All right. Okay, so I will be happy to answer more questions. Yeah, but let's review. Let's review some of the things that we've learned here tonight. You review your notes, and these are some of the things we talked about so far tonight. Trading options on ETFs and stocks can and should be done about 5 hours a week or about 1 hour a day. Why the time restriction? Because when you restrict the time, you don't see things that aren't there. You don't press trades that aren't there. I put this time restriction on myself. Okay. So we use time as a tool. And what's really a great side effect of that is we're not having to be glued to our charts all the time. Why? Because we're using our platform to alert us to when our trade price level has been reached. Use the platform as your trading partner, because that's really what it is. Okay. Let's talk about the right watch list. We've talked about this word quite a bit. Like, Rog, oh yeah, we know what you're going to say, double green. What is that double green environment? Again, we want to focus on uptrends. Most traders do well in a double green uptrending environment. That is, for most traders, the foundation of your trading success. Now, does that mean you can't trade downtrends? Oh gosh, no, not at all. You can absolutely trade downtrends. I'll tell you what, little secret, I love downtrends. You guys saw my March results? My March results were, I think, 123 for the month. Why? I love downtrends. I just happen to trade them really, really well. They don't usually last for very long. Can we trade them? Absolutely. But most traders are going to do really well in that double green uptrend. Okay. Now, this is huge, and you're going to find this is going to continue to be very important for the remainder of your trading career. Why? Because ETFs and their influence, they're not going anywhere. Okay, ETFs make our life easy. They guarantee us a certain amount of attention and liquidity, and they help us cut down on time and focus in the right place. So you're going to be amazed how often cutting down time and increasing focus is really very similar. We use the pre-curated watch list of the indices and the ETFs. They've already put, right, whether it's an ETF creator, whether it's the index themselves, NASDAQ, Dow, S&P, they've put a list of stocks together. They've told us what's important. They've told us what's moving the market. I'm just following their breadcrumbs, right? So gone are the days of not knowing where to look. They're telling us where to look, right? They're telling us where to look. I'm not going to sift through hundreds and hundreds of names, right? I'm going to look at those names that are part of these pre-curated watch lists, and then I'm going to look for the environment that we all tend to trade best in, double green. That's the secret, gang. All right. What's double green? It is, and for those of you wondering, okay, Rog, what is that? It's actually an indicator, but it's also the way in which the 8, 13, 21, and 34 EMAs are structured. It's the relationship of these 4 EMAs. And when they're in the right order and they're behaving in a specific way, we have a double green market. And a double green market is going to be your highest probability environment. All right. So where can you get the pre-curate? The ETFs, the ETF weighting, the stocks within the ETFs, and the weighting of those ETFs. That's what's going to give you that watch list. All right. Okay. And here's really where you take everything that we've done here, here, and here, and now you're going to supercharge it. Because now that you know what to look at, because the ETF weighting and lists are telling you where to keep an eye on it. Same thing with the indices, by the way. Now we look for the relative outperformers. What is another way of looking at it? What is best of breed, right? Relative outperformers. Let's talk about what that means. If some stocks are going up gradually and others are behaving with much better organization, they're relative outperformers. You know what's a good example of relative outperformers, gang, that I showed you today? Schwab. XLF, dumpster fire. Do I want to trade most of what was in the XLF? Negative Ghost Rider. But Schwab was a relative outperformer, right? That's what I mean by that. That's what I mean by that. So it's in the XLF. That's your pre-curated watch list. And it was a relative outperformer. right? That's where you take everything we've talked about and you supercharge it. That's where the best watch lists come from. That's the best of breed. There is a specific market that most traders see most of their winners in. Absolutely. And that's that double green. That's the relative outperformer in an uptrending market. Okay, that's what you want to focus on. And here's the next part of this. Keep this in mind. You want to know when the market organizes into an uptrend, and you need to know when the market disorganizes, right? That's what you need to know, when the market organizes and when the market disorganizes, right? Because once it's no longer behaving as a relative outperformer and it's no longer in an uptrend, what do you need to do? You need to go back to building that watch list again. Okay? All right. So let's also think about what a trend allows us to do. If you've gotten into a market and it's trending and you get out because you scaled out or it pulled back, if the structure is still relative outperformer, double green, stick with it, gang. Stick with it. A lot of traders want to bail on winners too quick, just as much as they tend to hang on to certain markets that they shouldn't be in too long, right? So there's a balance there. Now, the dominant psychology of the market is our path of least resistance, or what I've referred to here as we've been together called directional bias, right? There's no need to chase trades. There's no need to keep seeking shiny and new. The ETFs and the indices have told us what to watch. You know, you guys know this probably anecdotally. Think about this for a moment. How many of you are familiar with the ARK ETFs? We watch those too. And the ARK ETFs, because that's an actively traded ETF, and I think that's going to be much more popular and definitely influence our 2021 trading. And I am super excited about that. Okay. Because we have these actively traded ETFs with high concentration weighting, I'm following the breadcrumbs, gang, almost like coattails. That's really what we want to be able to do. We're looking at the size, we're looking at the attention, and we're letting them choose, the money choose what they want to move, right? So there's no reason to seek out shiny and new. They're doing it for us. Let them do the heavy lifting, right? If you guys aren't familiar, ARK, it's the hottest ETF, some of the best returns of last year, right? And what do? We coattail that. They're doing the heavy lifting for us. Okay. So what else do we want to be? We want to be patient and let the trades come to us. Those are the pullback buys that we talked about, waiting for those pullbacks, making sure that we're giving our trades enough time before expiration to not only get traction and resume the trend that they were in, but also so we can really milk the follow through of that path of least resistance, right? And set yourself up for more and bigger winning trades while minimizing your losses. Now, how are we minimizing our losses? Because we're waiting for pullbacks in inexpensive stocks. By the way, gang, your risk is absolutely correlated to the cost. You cannot extract that. Your risk in more costly options is higher. I'm not saying they're bad trades, but if you're thinking, Rog, yeah, I really do want to control risk. Again, whether you have a $10,000 account or maybe a $110,000 account, who doesn't want to control risk? Right? So your risk is absolutely correlated to your cost. Keep that in mind. And pullbacks help us reduce risk because we're reducing cost. And by the way, gang, what we've been doing here now for about 45 minutes or so, this is what we're doing. What I've laid out, what I look for, how I trade it, the environment that works, how we build our watch list, what my watch list come from. This is what we do in the Sector Secrets Mastery. Okay. So what are we doing in this? We're mastering, we're trading options together in this community of people who are looking for the same kinds of trades. Here's what's really cool. We have our monthly live trading, and yes, you're going to get my instant real-time alerts. Something that we do, it's a little different, is that when I send out the alerts to you guys, we send out an alert to be aware of something. I call it my radar. I let you know when I get in it. Then I again let you know what's on my radar to get out. And then I let you know when I get out. So you can prepare, right? You know what's coming. You know what's coming. So Yeah, absolutely. I'll let you guys know what my watch list is. I'll let you know what's on my radar. And then I'll let you know when I've gotten in and out. And then, of course, we have an updated trade spreadsheet. But, some of the things that we do are in the community. We have watch lists. So you know what I'm watching, right? What's on that radar. And then from there, we get our alerts. All right. Now, we get together once a month, but I'm actually in that room far more often. And actually, bonus sessions are pretty common, because if the markets are moving and doing something that I want to make sure that you guys are aware of, taking advantage of, yeah, you're going to get a video. We'll have a bonus session. And of course, alerts. Again, the idea, though, is you're not going to spend a lot of time. In fact, you're going to spend a lot less than 1 hour, because I'm spending the 1 hour for you. But the cool thing is the community that we have is scanning for the same types of setup. So if you're brand new, we have a bunch of people in the room already. And what are they doing? They're looking for double greens. They're helping each other out. They're alerting each other to timing. So if you're looking for a community and not just my trades on your phone, which is totally fine, right? We've got both. We've got both. Okay. And that's where it gets really exciting. And I'm so, so grateful and pleased about the community that we have. Okay. So it's a combination of this family of traders that are trading all in the same direction, supporting each other. And then, of course, I'll let you know when I am getting in, when I am getting out. Okay. So that's what we're doing over at our mastery. You can check that out at simplertrading.com/sector. All right. And trading is no fun to do alone. No doubt about that. All right. Let me give you guys a schedule so you can pencil in, when to set aside some time so we can do live Q&A, live trading, live watch list building. This isn't Central Time, but I always think in East Coast time. So yes, it's 12:30 to 3 Central, or 1:30 to the close, 1:30 to 4 Eastern. All right. We get together once a month, but we actually get together far more than that. I have a tech session that I do with you all where I share with you guys my tools. I have a number of free tools that I make available to members. You guys got to actually see a number of those on my charts. So I make those tools and indicators free to members. We have a tech session that we do once a week, so you can get started, get the layouts, get the indicators. And that's in addition to these sessions throughout the year. Okay. All right. So then 2 ways to join me: quarterly, annually. If you do the math on the annual, it's actually, I guess it's almost like getting a quarter for free, almost. But you can join me. Now, again, remember, we're trading end of day or daily time frames. So yeah, giving yourself the time to get the watch list and let some of these trades that oftentimes can move in our favor 3 or 4 weeks, right? 3 or 4 weeks. Yeah, you give yourself the time. Someone asked, how long am I usually in a trade? On the low end, sometimes it's 3 or 4 days. Look, if I hit my target within a few days, we're going to pay ourselves while we can, not when we have to. But then if the trade is going in our favor, and of course we don't have the time crunch of expiration, yeah, it's not uncommon to see trades go for multiple weeks. But on the low end, it's about 3 or 4 days. Again, this is not hyperactive trading. It's trading designed for you to be able to put in your orders, whether they be limit orders or alerts, and then just wait for the market to come to you. All right. So this is not high intensive, high babysitting, high maintenance trading. I don't like to trade that way. Not only do I not like to trade that way, I find it categorically unprofitable. Too much micromanaging, over trading, watching every tick. It's not going to serve you, gang. In fact, when I first started trading, I used to get my charts by mail. There was no internet for traders back then. I got my charts by mail. I slowed things down. And I found that that's where some of my best trading really took place. All right. So our first session is on January the 25th. But like I said, I mean, if you guys join up today, you're going to see me in the room tomorrow. We got some cool trades going on in things like silver with the silver ETF. We got some trades going on in a bunch of things. So yeah, you'll see me tomorrow. And for those of you wondering how many trades we put out a week, it's about 3 to 5. Sometimes it's closer to 3. Sometimes it's more than 5. But it's about 3 to 5 per week. minimally, usually is what we're looking at. How much do you need to trade? Love the question. Gang, if you have a smaller account, remember a lot of the options I was sharing with you guys were in the $3 range. So that's $300. Can you trade 2 or 3 of those? I think so. I think most traders would say a 10K account or even less can trade those. Absolutely. Yeah. So if you have a larger account, because we're looking at stocks that are heavily weighted within the passive investing universe, if you want to buy it more than 2 or 3, right? Let's say you want to buy 20 of them, depending upon the open interest and volume. Yeah, a lot of times that's not out of the question either. Some of you might say, gosh, Ron, $300 option, I'm pretty comfortable with 10 or 20 of them, right? No problem. It's scalable. It's scalable. Okay. So let me also tackle a few other questions. The tech sessions are every week for 30 minutes because, part of what I do is I have a lot of unique indicators. Most of my indicators have been created by myself, right? They're indicators that I created early on in my career. And so they're a little different. So yeah, we have a specific tech session that we do where I can get you guys started, getting your chart set up, getting the tools set up. Absolutely. Yeah. And most of my indicators are for members only. So, because I can only support folks who have access to me to show you guys how to set these things up. Yeah. And the indicators, for those of you that are wondering, most of my indicators are available on TOS. There's a number of them that are available on TradeStation. I use TS10. I have quite a few that are available on TradingView, and we have a growing number of indicators available on Tastyworks. Okay. Can I draw a mustache on myself? Oh, look at that. I've always wanted to do that. Look at that. Okay. All right. Let's see. When I post a trade, do I also suggest how many contracts? Bala. So one of the things we discussed a little bit was this idea of how much in a bullish market, when we're getting a pullback, right? We get that pullback. How much is it going to cost you? Depending upon the cost and depending upon your account size, one of the things that I teach you guys and I show you guys is what I call market money math. Market money math. And what that does is it takes a certain percentage of your account, and you can do this too. You take a certain percentage of your account that you're comfortable to risk, right? And then you figure out what that dollar amount is. Now you know what you can risk per trade. And once you know what you can risk per trade, you know how many contracts you can buy. It's a little unusual. Like I said, a lot of what we do is counterintuitive. So it's working backwards to avoid risk of ruin, to avoid blowing up an account, something that I've never done. Why? Because I know when to shut it off, right? It doesn't mean that I never lose. It just means that I don't keep losing, right? That's what I want to prevent for you guys. So I have a couple of questions. How did the strategy perform last year? Yeah, we showed that right on the onset of the chat. I'm happy to scroll back there. Sorry for there we go. Rewind, rapid rewind. So this was I believe it was 27K account in January. Okay. And typical trades, how much did I need to put on most trades? On the low end, I usually need $1,100 to put on the trades, again, based on how many contracts I bought. On the upper end, it was usually never more than $3,000. Now, what do I mean by that? $3,000 worth of contracts, $2,400 worth of contracts. So yeah, this is how much I needed to put the trade on. So you can see it's relatively affordable, and that is per position. That was per position. So I'm not talking hugely expensive trades, just putting on consistent trades on pullbacks. And as you notice, a lot of these were $3, $4, $5. Some of them are $11 options. I mean, we're not always trading inexpensively, but yeah, they're affordable. They're affordable. Okay. So thanks for the question. This is my 2020, gang. That's 2020, and this. So I have I think I have currently 6, but this would have been one of 5 of my accounts here in my office. So this is one of my 5 accounts here in the office. And the way that we differentiate accounts is by how much we're willing to put per position. And these are things that I'll teach you guys because this is part and parcel with controlling risk and putting on the trades that I'm going to share with y'all. Okay. All right. So let's see here. Next question is, let me put these dates up here for you guys again for a little bit. Am I using in the money calls or spreads? So house money, I will use put credit spreads. I will collect, let's be even more granular about it. I'll collect credit in very specific scenarios for usually highly expensive stocks. For me, $40 and above is usually a cutoff. Okay. The rest of the time, I will use spreads, say call verticals, to offset the cost and the loss. But I do something unique with call verticals. I leg into them. So I don't get into call verticals in the traditional way, which is actually very, very inefficient, right? They're very inefficient. Do we do put credit spreads? Absolutely. But I think collecting credit is actually grossly overused and actually puts traders in a lot more risk than they realize. It just feels good to take a credit first, right? I typically stick with debit and I typically go directional. But when I go call verticals, for example, we do a spread, I will leg into them. Yeah, very often I will leg into them. All right. Okay, so then let's see. So how much in your account for 2,400? Look, you can go even lower and go with 1,000, Grace, to your question. So you get to actually choose your own adventure there, quite frankly. So if you have, say, $10,000, well, I'll go verbatim with your question. How much do you need in your account to go 2,400 per trade? If you want 2 positions at a time, right? 2 positions at a time, and you're looking at an average, if you're comfortable with $2,400, I would say you want 10K. I would say you want 10K, but you don't have to go 2,400, right? Some of the smaller positions were closer to 11. The larger were in the 3K vicinity. Okay. So that's where, once you understand the arithmetic that I alluded to, you get to choose your own adventure and determine what's right for you. Right. Okay. So yes, you can do this with 5 or 10K, gang. You're just going to pick and choose the setups that fall within that affordability window for that size account. And again, it's not uncommon for us to look at $2 and $3 options. Not uncommon at all. We just had a trade last week in Exxon. All right. And if I recall, these were approximately $380 options, if I recall. So, yeah, so these are just something we did last week. Yeah, this is something we did just last week. So you don't need a lot of money in the account. However, because these are liquid options, if you do have a larger account, you just scale in with more contracts. That's why we follow where the size is at, because it gives us that liquidity. And I don't trade illiquid stocks. I don't trade illiquid stocks. It's too much risk. All right. So most of the trades that I share with you guys are really straightforward. Long calls. That's what I do most of the time. We keep it really, really simple. When I'm not looking at long calls in our double green, we will look for sometimes put credit spreads. Yes, sometimes I'll go with call verticals, but I really rely on getting the long call part of the trade right. Okay. After that, I've got a lot more selection and choice. In fact, sometimes a long call can coexist with a put credit spread. Sometimes always a long call is going to precede a call vertical. So you have a lot of choices. You can overlap. You can kind of mix and match, as they say. It depends on the underlying behavior of the market and your budget and what you're going to allow yourself to risk. Okay. How many open positions do I hold at a time? It depends on the pullbacks, Heath. But again, because you guys are going to know and learn how to be selective about what works for you and the size, a lot of that is up to you. It's not uncommon for us to have 3 to 5 positions open at any given time. And some of that's going to be trades that are continuing to work in our favor. We just haven't scaled out of them yet. For some examples for that would be things like we're long Deere, right? I'm not actively getting in, but it's working in our favor. We still have time. So it's still a long position, but it's in no risk of going negative, right? It's in no risk of doing anything but risking unrealized profit. Another one is TAN. Again, we're just letting it go in our favor. We have positions in XLB, just letting it go in our favor. So there's a number of them that might be open for, like I said, weeks. What's going to dictate when we get out is time decay. It's going to be the expiration of the option sometimes when the trade really gets cooking. And that means the trend is, the wind is at our back. The trend is in our favor. All right. Let's see what else we have here. Can you use Toss? Yes. Can you use Tasty? Absolutely. Absolutely. TradeStation? You bet. I don't believe look, we're trading liquid options on ETFs and stocks. Yeah. So I'm not here to tell you who to trade through. You trade through whoever you're comfortable with. Toss and Tasty are terrific choices. How far out of the money? No, I seldom will go out of the money. Slightly in or at 45 days to expiration. But you got to get the watch list right. You got to get the timing right. But once you got that down, yes, as a general rule, to your point, I want to focus on Zohib. I want to focus on at or slightly in and 45 days minimum typically to expiration. All right. Next up is, let's see here. Will this enable you to do this on your own at some point? RK, that's my hope for all of you. My hope for all of you is being fluid across multiple stocks and ETFs and being fluent enough. Yeah, it's really cool, RK. In the community, this is really cool. To your point, at some point, will you be able to do this on your own? Here's what's really neat. In the community, yes, you're getting my alerts, but we have a chat room that's open all the time. In fact, I log into that room every day. And when I log into the room, I see a bunch of members already in there talking about symbols, sharing the double greens, looking at the zones. So yes, you're going to be able to do this on your own. But then in the meanwhile, you're going to have this family of traders, this community of traders that are looking for the same types of trades you are. And they're actively in that room talking to one another. I kind of, this morning I was talking to them and I said, hey, this is like our think tank because we're all doing things in a similar manner with the same tools, right? And it's our think tank. And some of the traders were taking some trades along the lines of what I point out and, sharing them with the members. And a lot of them were taking trades on their own. And again, to your point, yeah, they're learning how to do it, but they love the community. They love having that double green trading pullback family. That's what we're there to do, support each other. And they do. We have such a great group of people in the room. All right. What other questions do we have here? Just bear with me here, gang. All right. Well, I teach you guys how to scan and look for the sector. So SP, you got the beginning of that now, right? And I know it might sound really simple, like Ron, the ETFs, that's what you're using. Absolutely. What happened in 08, gang? In 08, aside from the financial crisis, ETFs began to eat mutual funds lunches. ETFs are becoming more and more influential on the market every single quarter. So now here we are 12 years in of ETF influence and volume and flow. And I track that. Because what they're trading is what's moving the market, gang. Indices and ETFs. So 12 years later, they're more influential. And 12 years later, they're doing the heavy lifting for us. So yeah, I'll teach you how I scan the markets, but a lot of it's done for you. Again, I can't emphasize enough the time restriction of, hey, spending less than an hour a day, if that's what you want to do, less than an hour a day is about focusing only on the cream of the crop, the best. And so part of that process is using those ETFs to not only shortcut, but really laser focus what you want to be looking at. Okay, we can look for needles in a haystack. I think a lot of people like to find that one stock that's having a stellar year, but that's a needle in a haystack. I don't want to do that. That's frustrating. I actually want a surer thing than that. I want something easier and where I'm more certain to find the attention and the volume. All right. What else do we have here? So, by the way, for the questions for those of you that are in the options room or the futures room, no, this is separate from that. This is a separate room where there are my trades, my tools, and my alerts. It's a completely separate room from futures, from options. I know a few of you asked that question. No, this is our little community of double green pullback, inexpensive options traders working on that way in which we can find the best of breed within this actively traded ETF world that's giving us not only ETFs we can trade, but also individual stocks that are tracking with them. You know, every single stock that I share with you guys in this, they're all connected either to each other and to an index, an ETF by weighting. That's why I'm able to do this usually with a clear sense of the direction of the overall market or the sector that it's involved in, and with less time. Because again, the ETF is telling me what to focus on. I just have to find the market that's behaving in the way that's the relative outperformer, and then I have to find that strike zone, right? And then that's what I alert you guys to. Margin, I mean, we're options trading. Can you trade this with a cash account? Yes. If you guys want to trade with a cash account, absolutely. No problem. That's not an issue at all because, well, at that point, you'll just be focusing mostly on my long call or long put trades. But yes, you absolutely can. Let's see. Are these futures trades? No, they're all stock option or ETF options trades. All of the ones that I share with you guys today. By the way, though, this is where it gets really cool, okay? And this is where this year it's going to be a big deal because we have a reflation trade going on. And that is, you know, do I trade the ETFs on certain commodities? Yeah, we just put out an alert today for silver. Will I put out trades for certain currencies? Yeah, we've got our eye on the FXA, which is a play on the Australian dollar, right? If there's an ETF that allows us to trade different indices, QQQ, we have an alert on QQQ. We just got long from an aggressive level on QQQ, right? So whether you trade NQ or QQQ, or whether you get even more granular looking at things like XLK, which, by the way, is on the radar. Yeah, absolutely. You can see some interesting overlaps. And then also country ETFs. Look, it's not just the US that's got a market heading higher. It's a number of countries where they have liquid ETFs, and you can play options on the stock markets of other countries, currencies, commodities, countries. A lot of these have liquid ETFs. So yeah, you can definitely broaden your horizon. And I love doing that because it allows us to take advantage of a lot of different narratives. Okay. Okay, what else do we have here? Again, you don't need a certain size account, gang. I don't want you risking capital that you don't have. Take a few trades, follow me for a quarter, understand the process, get the math right, and then naturally you'll feel comfortable putting on larger trades. Okay. All right. Let's see. Again, the trading platforms that I use predominantly Thinkorswim, TradeStation, and TradingView. And yes, a number of my indicators now are available on Tastyworks, but mostly it's Thinkorswim and TradeStation and TradingView. All right. Okay, gang, let's see. As far as what time these trades go on, gang, they don't have a set time, which is why what I teach you guys to do is place alerts. Sometimes it'll happen in the morning during the clearing range volatility. Sometimes it'll happen at the end of the day with the closing. Sometimes it'll happen in the middle of the day. But rather than you having to be glued to the market, which is going to make you overtrade, what we do is we use alerts and conditional orders. Okay? All right, gang. So that is it. Thank you so much for all the questions. I really appreciate it. I hope this has opened your eyes to the way that you should be focusing on the different environments that you're trading. Prioritize certain types of stocks, moving in a specific way, double green. verify that they're relative outperformers within the sea of stocks that they trade within, an index or an ETF, and wait for your pitch. Take advantage of those pullbacks in the uptrend. Okay, gang? So thank you so much for your time. Again, I hope this clarified, again, not only how I trade, but you could put some of these tactics to work tomorrow. All right? Tomorrow. All right. So again, these are the dates for our live sessions, but we have more than these sessions. We have our tech session, and I usually have another extra few sessions every month. So, but these are our big live trading. These are set in stone, and then bonus sessions. And then you can join me at simplertrading.com/sector. Okay. All right, gang. I'll be in the room tomorrow, so hopefully I'll see a lot of you. And if you are in the room tomorrow, introduce yourself. Let me know you were in the webinar. And yeah, looking forward to meeting y'all tomorrow in our Sector Secrets Mastery Room. All right, gang. Be good to each other. I'll talk with you soon.